Hi everyone, welcome back to the Advanced Mortgage Solutions podcast, the podcast that assists people with their property journey. Whether you're a first home buyer or a seasoned investor, we cover all topics. I'm Joel Sadler and our mortgage expert today is Scott Miller, owner and founder of Advanced Mortgage Solutions. Today we're going to talk about LVR. What is LVR? So Scott, over to you.
Look, it's a common little acronym that you're going to hear a lot. Particularly probably for a first home buyer, LVR. It stands for loan to valuation ratio. And what it means is, as a percentage of the value of your house, how much is the mortgage? So the loan to value ratio. And it's important because the Reserve Bank has put certain restrictions down to the banks to say, hey, if you're using the first home loan, the maximum LVR is 95%. Now, that might not mean much to you, but what it means to the applicant is that, I only need a 5% deposit. Equally, if we go directly to a bank, then the LVR is 90%, which means you need a 10% deposit at the absolute minimum. And then the best kind of deposit to have is an 80% LVR, loan to value ratio, which means you've got a 20% deposit. And at that 20%, you get all the love that the bank can give you. So it wouldn't matter if you came to me with a 50% deposit or a 20% deposit, I would be able to get you the same amount of love. That's a magic line. It's always been around since I've been doing this for 20 years. If you have a 20% deposit, everything's made easy. From that, it's a little bit harder and more expensive the further you get away from a 20% deposit, but that doesn't mean the bank can't help you. It just means they're restricted a little bit in how much they can help you in that space.
Right. And so that's a legal thing, is it? There's rules set by the government or
by the Reserve Bank.
law?
The Reserve Bank holds
right.
the bank's licenses. So in a sense, they can sort of say, hey, we'll tell you to jump. And the bank sort of says, well, how high? I'm sort of making light of it. But there's certain rules and restrictions that are sent down from the Reserve Bank to the banks that the banks simply cannot break. It's not that they're being mean or unhelpful or anything like that. It's just, I don't know, you're not allowed to drive straight through a stop sign. Why? Because it's the law sort of thing. That's the same kind of, they're not allowed to do it, and they can't do it. I know sometimes it feels like, the bank's being so mean. And in this instance, it's not. It's got nothing to do with the bank's appetite for that type of lending at all.
Yeah, right. Okay, well, that's quite interesting. Yeah, and I've heard something in the grapevine at the moment that there might be some rule changes or something allowing banks to approve more lending for less than 20%. Less than 20% deposit.
Very good ears, Joel. Yeah, right? Very ears to the ground there. Back in October, it was announced that the amount of loans that a lender could write is increasing from 15% of their overall book. Could be above 80, so less than a 20% deposit, and that's increasing to 20% of their whole book can now be written where there's deposits less than 20%. So it doesn't change the level of deposit that an applicant has. What it changes is how many applications a bank can now approve where there's less than a 20% deposit. So that's sort of gone up by, 25%. So it's significant. It just means more people can be approved. You're more likely to get a pre-approval when you have less than a 20% deposit, where when those percentages were lower, they would just say, hey, really, you have to have a live application for us to even look at that because we've got so few funds available because of the law to sort of accept loans above 80 that we won't give out pre-approvals. Now that we've jumped up to that 20% of their total book, you might find quite a few lenders now will say, hey, we've got a bigger capacity to write where there's less than a 20% deposit, and we'll either consider doing pre-approvals again. So it's a good change, a really good change.
Yeah. And is that sort of designed to stimulate the property market and get things moving again?
Is that they were brought in to do exactly the opposite, is to stifle the property market because, the housing crisis and the unaffordability crisis, all of those sorts of things, the loan to value ratio restrictions were brought in to try and strangle the market a bit and slow the market down. So there wasn't that pressure there to push house prices up. As that has started to work now, and we're finding it's probably petering out a bit, they're lowering the back end to stimulate the market, particularly helping first home buyers that are more likely not to have a 20% deposit than maybe subsequent or older buyers. Yeah. So you're
Right.
absolutely right. It's
Wow.
just in reverse now. So what was meant to
Yeah.
slow down the market now releasing to speed the market back up again.
Yeah. So as you said, in another episode, it's potentially a good time to look at buying now. Prices have come back quite a bit. Interest rates are falling.
Yeah.
They're stimulating. Their LTV,
I'll,
LVRs
well, I'll
changing.
say it
Yeah,
again. I mean,
it's
this is my
interesting.
seventh cycle,
Mm,
and I've just never seen
yeah.
15 months in from interest rates reducing. We started 15 months ago.
Mm,
House prices haven't gone up. I mean, normally interest rates go down, house prices go up. They're
yeah.
just so intertwined. It's not funny, but that this time round has not
Wow.
happened anywhere in New Zealand.
Wow.
So
Interesting.
it is a
Mm,
magnificent time to be buying a house because the
mm,
prices are reasonable historically,
yeah.
and interest rates, as you mentioned, are low. So yep, yeah, yeah, and we're very
Yeah.
busy because of it. Yeah,
Yeah.
yeah.
Great. Well, if anyone's thinking
Yeah,
of it, reach out to
that's
Scott
right. Yeah,
now
yeah,
and
yeah, yeah.
yeah, take
Oh,
advantage of this moment
and
or
it
this
won't
time.
stay
Yeah.
forever, right?
Yeah.
Those kind
That's
of
mm,
interactions where rates go down and house prices go up, they're very regimented things. So eventually,
yeah.
it'll kick into gear and it'll be just crazy times. Like I think we'll see
Yeah.
double-digit growth when
Yeah.
eventually
Yeah.
that sort of sentiment in the market changes. And when it does
Mm,
change, it will also change pretty quickly. I think people are just going to say, "Oh yeah, hey, I
yeah.
don't want to miss out."
Yeah,
Yeah,
yeah. It seems to be New Zealand has those sort of cycles, don't they? Where every sort of booms and then pulls back and booms and
yeah.
pulls back.
Yeah, I think this round has
Yeah,
been tempered a wee bit with the cost of living. Us still getting over the,
yeah,
the
right.
COVID hangover and the economy
Mm,
rebounding
mm,
from that. There's other things at play here.
mm.
I get that, but to say that it's a great time to buy is the understatement of the century. This so far, anyway. It's just, yeah, it's a
Yeah,
good time.
awesome.
Hmm.
So we've spoken a little bit about what does that all mean to the purchaser. We've just covered
Yeah,
that off now. What about the other side of it,
yeah,
the vendor or the seller?
yeah.
So how does this LVR change
This
to the
is
seller?
one
What does
that
it mean?
many people get caught out on, right? So if
Right.
you've bought your home and then maybe used the equity in your home to buy your first rental, you've owned the
Yeah.
rental for a couple of years now, and you say, oh, actually, I wouldn't mind making some money off the rental. What you've got to make sure is either when you sell your home or the rental, depending on which one you're going to sell, you have to still meet the loan to value ratio restrictions. So there's been times where maybe the person's absolutely pushed the equity in their own home to the limit. Um, they've bought
Yeah.
a rental, say, at the height of the property cycle. It's now
Yeah.
near the bottom of the property cycle. They're not getting as much money for the rental as they wanted to. So when they sell the rental, that would leave an overall loan to value ratio on the house that remains, their living house, over 80.
Yeah.
And the bank would have to say,
Ah,
no, we can't release the equity because it would place us outside of the loan to value ratio restrictions. Now, that can be a
right.
real difficult situation if you haven't worked this through and you've accepted and confirmed on an unconditional offer of finance that now the bank won't release the security. So you can imagine that
No.
this is quite an uncomfortable position to
Yes.
be in. So if you're thinking
Yeah.
of
Yeah.
selling out there, guys, anyone thinking of selling, make sure you talk to your advisor to make sure you're meeting the loan to value ratio restrictions once whatever you're selling is sold. Yeah,
Wow.
it is
Interesting.
super important. And
And
again, going
and
back to the
and
banks, this isn't the banks being mean or funny or horrible. It's them following
yeah.
what we and you and I would call the law as such. It's just what they're being told they have to do. Hmm.
Yeah. And also potentially, like obviously you said they might not release the security, but if there is enough um, cash flow or capital left over, they may want to hold on to some of that or have some of that allocated to the remaining property to
100%.
keep that
Yeah,
ratio.
so
Would that be fair to
yep, it
say?
is fair
Yeah.
to say. They
Yeah.
may use some of the
Yeah.
sale proceeds to top up, or when
Yeah.
I say top up, I mean reduce the size of the
Mm,
remaining mortgage to make sure
mm,
they're meeting the loan to value ratio restrictions. So if you sell your house
right.
for 600K and you've got a 200K mortgage, it doesn't mean that you're going
Yeah.
to get your hands on the whole 400K sale proceeds if you're not
Yeah.
meeting the loan to value ratio restrictions over here.
Yes.
And in fact, in that interest in that instance, it would be a really good idea to tell the bank before you sell to say, hey, I don't want to use all of the sale proceeds from selling this house and paying the remaining of my mortgage back. I want to keep a couple of $100,000 for myself. Otherwise, the assumption is by selling that asset, it's going to pay down the mortgage on what remains completely and you'll get no money. So you have to tell the bank what you want to do with the money once you sell. Ultimately, after you meet the loan to value ratio restrictions, you do have some say in what happens to that money. But if you don't give them the heads up, they'll just go and pay down the rest of the mortgage on your own home.
Interesting. So essentially the takeaway is really, if you're buying or selling, speak to an advisor. That's key takeaway really, isn't it? Because there's so many changes and things going on. People have busy lives. You don't always you have time to keep up with all this sort of stuff.
That's right. And it changes all the time in the background, So what we were doing 2 years ago is considerably different to what we're doing today. And of course, people don't buy and sell that often usually, so they are relying on what they know was right at the time they either purchased or sold last time, thinking that it's the same. And quite often they'll say, oh, I didn't realize that had changed. And it's simply because they're not plugged in on a day by day, week by week basis on what's happening with the rules around buying and selling property, loan to value ratios, all those sorts of things.
And again, it sounds to me that, banks are generally pretty flexible if, as you said, they've gotten notice and there's an advisor like you that they trust,
they're not out there to
can
annoy
massage
you.
it through.
It might feel like
they want your
sometimes
business.
that they're there to annoy you, but that's not their operate. They don't operate that way. They're there to facilitate, make a profit, don't get me wrong. But if you give them the heads up and tell them exactly what you're looking to do, then they'll go out of their way to try and accommodate that as long as it meets the rules, which they're not allowed to break. So, it's a really good point.
Yeah, makes a lot of sense. All right, Scott. Well, look, is there anything else that you want to add to this this piece around LVR? Any nice tips?
Not really. For the first home buyer, like I said, for certain circumstances, there's as little as a 5% deposit. If we have to go directly to a bank, that's meaning not using the King Aura product, so we're going directly to ANZ, Westpac, BNZ, all of them. Then you need a 10% deposit, and anything more than a 10% deposit is good. But a 20% deposit gives you absolutely all the bells and whistles that can possibly be given by a bank. Easy.
Brilliant. All right, Scott. Well, look, if someone wants to move forward and take advantage of this amazing time to buy, how do they get hold of you and get one of these consulting meetings? And they're free, right? These meetings are free. And how do they get hold of you?
100%. Yeah. Look, we typically send out a little bit of homework before we meet you, just so we know all the nuts and bolts and crunch some numbers for you. So the conversation that we have is very educational, but very sort of relatable to the situation or the statement of position that you find yourself in at the time that you're looking to ask for finance. It makes those meetings very efficient because you come out knowing that you're ready to go. If you're not ready to go, we don't just say, oh, too bad, sorry it didn't work. We'll give you a little bit of homework. Hey, look, this is what we need to do. Sharpen up here, do this, wait for that, and then we can have a look at it again. So there's multiple different ways of sort of helping people get to their goals of buying a home. It's all on the website. It's probably the easiest way of getting hold of us. So that's advancedmortgagesolutions.co.nz. There's contact forms, broker contacts, a lot of sort of informational pages there to help people through the process.
Awesome. Thanks, Scott. We'll see you on the next episode.
Thanks,